Okay, hello everyone, and a very warm
Recording in
welcome
progress.
to you all to this workshop on the global economy organized by the International Finance Forum. It's really delightful to have you all with us. It's my great pleasure to introduce to you my distinguished colleague and friend, Ayhan Kose. Dr. Kose is the Deputy Chief Economist of the World Bank Group and Director of the Prospects Group. He's a member of the Chief Economist's leadership team at the World Bank Group, overseeing the institution's analytical work and policy and operational advice. Ayhan also leads the bank's work on the global macroeconomic outlook, financial flows, and commodity markets. Under his management, the Prospects Group produces the bank's flagship reports, Global Economic Prospects, which we will discuss right now, and the Commodity Markets Outlook as well, in addition to other policy and analytical publications. Prior to joining the World Bank, Ayhan was assistant to the director of the research department and deputy chief of the multilateral surveillance division at the IMF. He served in a wide range of roles supporting the IMF's analytical, policy, and operational work. Dr. Kose has written extensively on international macroeconomics and finance, and his articles have been published in many leading academic journals. His latest book was called Falling Long-Term Growth Prospects, and it examined the evolution of global potential growth and its underlying drivers. His recent policy work has focused on global inflation, debt challenges, and business cycles. But for the topic of our discussion today, we are going to focus on the Global Economic Prospects for 2024, which was a report led by Ayhan and published earlier this year. It's a report that gained widespread global attention, and I'm sure many of you saw some of those media reports. I noticed some headlines around global trade has nearly flatlined. That was one headline. I saw another one. A silent debt crisis is engulfing developing economies. Cautious optimism on inflation. But you know, the headline that caught my attention most was that this came from the report. The global economy is set for the weakest half-decade performance in 30 years. So that certainly got my attention. I know it will be of interest, not to say concern, to many of us here. And again, it's so fortunate, we are so honored to have with us Ayhan to describe and explain all this to us. So the way this will work is Ayhan's going to take over now and make a presentation, probably for about 20-25 minutes. He's going to walk us through exactly what are the global economic prospects for 2024 as the World Bank sees it. And then we will leave time for questions. So if you have a question, please post it in the question and answer platform that we have available, and we'll try and take as many as we can once Ayhan has concluded his presentation. And if you can, please identify yourself with your question, because that always makes it a bit more interesting and fun too. So with no further ado from me, let me warmly welcome again and ask Ayhan to please go ahead with his presentation. Thank you, Ayhan.
Thank you, Gerry, and really thank you for inviting me.
Good morning, everyone. It is great to join International Finance Forum to exchange views on the global economy. Gerry mentioned some of the messages we have. Obviously, I will talk about those a little bit, but I look forward to hearing from you, your views, and learn, how you are basically seeing the global economy. So I'm gonna go through these slides, and I will make sure these slides are available to those who are interested after the presentation. Let me start. Okay, so everything is good, Gerry? The slides look good? Excellent.
All good, Ayhan. Thank you.
So this report comes out twice a year. The latest report was January, and the title of the report was Subdued Growth, Multiple Challenges. I think this title explains where we are and how we see things. The report has four main parts. The first two parts are about the outlook, how do we see the global outlook, and how do we see the different parts of the world. In the World Bank, there are six regions we operate in, and there is, in a sense, an outlook for each region in this report. In addition, there are two thematic chapters. One looks at the accelerations of investment and the consequences, and then another one looks at fiscal policy and commodity exporters. I plan to talk a little bit about this investment acceleration chapter. So what I thought would be useful for us today is to focus on three questions. The first question is, what are the near-term prospects for the global economy? The simple answer is that the global economy has shown remarkable resilience, but there is a slowdown underway, and that slowdown will continue. Third year in a row, we will see weaker growth. There are good reasons for this: tight monetary policy, weak trade and investment. And risks profile is better balanced, but still on the downside. And there are major geopolitical tensions that could derail the recovery. The second question, what happens during investment accelerations? It's an important question because every policymaker is thinking about how to accelerate investment. And if it happens, it's like magic. Many good things happen. I'm going to talk about these. And then finally, what are the policy priorities? As much as the global economy has shown resilience, going forward, the big challenge for policymakers is to build on that resilience. And I'm going to talk about at the global and the national level, what should be done. Throughout the presentation, I will use this acronym EMDEs that stand for Emerging Market and Developing Economies. So very quickly, let me start with the forecasts. So here you see basically the forecast for the world economy, advanced economies, excluding United States, emerging developing economies, excluding China and the regions, and basically the kind of the forecast for different years. So for the world economy, we are expecting this slowdown, third year in a row, continue. Growth will slow from last year's 2.6% to this year's 2.4%. Despite, the kind of the sound somewhat subdued, but at the same time, last year what happened is quite remarkable, and we need to acknowledge that. At the beginning of last year, most commentators expected a sharp slowdown, even a global recession. A recession was expected in the US, a recession was expected in the euro area. Both of these basically economies averted recessions. And then I'm going to talk about the US economy has done remarkably well. But having said that, this slowdown is still underway. In a sense, we weathered the storm, but then the question is whether we see the sun in the horizon. So the next thing is that if you look at advanced economies, on the surface, yes, they slowed, but still they deliver growth around 1.5%. That number is largely driven by the US economy's performance. If you take the US economy out, actually other advanced economies slowed last year very, very sharply from around 3% to 0.8%. Going forward, we expect the slowdown in advanced economies continue as they feel more the impact of this monetary policy tightening. And of course, the weakness in the manufacturing sector will have an impact on the outlook as well. Now, turning to emerging market and developing economies, what you see is things are pretty stable. China last year delivered growth above 5%, in fact, 5.2%, and that helped a lot. If you take out China, what you see, emerging developing economies actually slow quite a bit from 4.2 to 3.2%. This year, we're expecting growth to be stable, and outside of China, growth basically to accelerate a little bit. Now, we need to put these numbers in context, and that context is a comparison with the average growth prior to the pandemic. And when you do that, what you see, whether you look at advanced economies, whether you look at emerging developing economies, growth this year, as much as we go through a very the difficult period, is there, but it is lower than what we saw prior to the pandemic, that decade from 2010 to 19. And let's don't forget, nobody was happy about the growth that decade delivered. So the next thing I'm going to talk very briefly about the regions. In the case of East Asia Pacific, still the region delivers one of the highest growth rates in the world after South Asia. We expect China to deliver growth around 4.5% this year, and the region as a whole to deliver growth around 4.5%. The other important region we focus on, at least for this presentation, is South Asia. South Asia, led by India, going to deliver growth actually around 5.6%. Obviously, that is the fastest growing region. And for the foreseeable future, given India's performance, it is going to be the flag carrier among the emerging market developing economy regions in terms of how much growth it delivers. So let me put these things against the backdrop of certain developments. So how should we think about growth around the world? The first observation is about how advanced economies are doing and how China is doing, because these are the engines of global growth. And from 2023 to 2024, advanced economies will slow and China will slow. So there's a reason for this slowdown. If you think about emerging market developing economies outside of China, it's important to think this group as two groups: those that have basically good credit ratings and those they do not have good credit ratings, meaning credit ratings below C or so. And there is a big difference. Countries, they have good credit ratings, strong credit ratings, as you see on the left. They deliver growth pretty much consistent with what they delivered prior to pandemic. And those weak credit ratings, they basically deliver growth, but much weaker than what they had prior to the pandemic. And those are the countries, they were affected by the tightening of monetary policy. So there are some countries, they are doing remarkably well, given the challenges, and some others not so well. The next big issue is the global trade. Last year brought an exceptional and unfortunate outcome. Global trade was flat. In fact, if you look at goods trade, it contracted. This was quite remarkable in the sense that we did not see these types of outcomes outside of global recessions. In fact, last year growth rate was the weakest outside of global recessions, over the past 5 decades. Global trade contracted for the first time outside of global recessions. So this year, we are expecting the sources that drove the weakness last year, including, this rotation from services, from manufacturing to services, and then, of course, certain challenges involving certain economies are going to be behind us, and we see a bit higher growth, around 2.3%. But still, that's going to be half of what we saw on average in the prior decade. The third important thing we need to keep in mind, the real interest rates in the US. Now, the real interest rates are around 6% in the US. That's the real cost of borrowing, and it is the highest rate we have seen for a very long time period. And it's going to be difficult, if not impossible, for these countries with weak credit ratings to take advantage of international financial markets. So for emerging developing economies, it's a difficult environment in 2024. Now, Gerry mentioned this observation we basically documented. When you look at this 5-year growth following the pandemic from 2020 to 24, it is the weakest 5-year growth in any period we saw since early 1990s. Why this is an important observation? It's an important observation because 2020s were supposed to be the decade of strong growth for the global community to basically meet the sustainable development goals. That's not going to happen in the context of poverty. It's not going to happen in the context of climate objectives. Growth is key to, of course, eliminate poverty, and growth is key to invest and accelerate climate transition. Now, some countries have done well. I would say China and India, since the pandemic, continue to get close to the per capita income levels of advanced economies, as you see in the middle. But when you take out China and India, convergence process stalled. So emerging market developing economies outside of China and India as a group was not able to get close to income levels of advanced economies. If you look at fragile conflict situations, there, in fact, they become even poorer. Now, if you look at the recovery from the pandemic, 1/3 of emerging developing economies haven't recovered yet, in the sense that their per capita income still below the per capita income what they delivered in 2019. This is a bigger challenge for low-income countries and fragile conflict states. So, how should we think about risks given this outlook we have? Risks, I think, better balanced relative to what we had last year, June, but still on the downside. One important change with respect to risk, we used to focus on financial stress as the number one risk threatening the global economy. But now the number one risk is conflict and geopolitical tensions. Now we have two major conflicts, Russian invasion of Ukraine and the conflict in the Middle East. Escalation of these conflicts could have serious repercussions for commodity markets. That could have implications for, of course, inflation, and that could have implications for financial stress. We are also worried about weaker than expected growth, near-term growth in major economies. So there are other risks, trade fragmentation, climate-related disasters, and over the medium term, weaker than expected growth. These are all risks we are focusing on and trying to assess the implications. I'm going to talk about one risk here, that's inflation. We think that inflation will continue coming down this year after basically peaking last year, but not as fast as many commentators and financial market participants think. And central banks will continue to be very cautious when they think about cutting interest rates. With that, let me turn to the second question. What happens during investment accelerations? So, whatever problem you think of in the context of economics, whether that problem is economic growth, it is eliminating poverty, it is creating jobs, it is basically thinking through climate problem, infrastructure, education, health, you need to invest. If there is a single big problem in the global economy, it is the lack of sufficient investment growth. Now, the investment gaps, investment needs are very large. The numbers are staggering to get to the climate goals, sustainable development goals. But when you look at investment growth has been slowing. In the first decade of this century, in 2000s, investment growth on average was around 10%. After that, it averaged around 5%. This year and next year, it's going to be around 4%. So we looked at past episodes of fast investment growth. When I say fast investment growth, countries deliver investment growth around at least 6% on average for at least 6 years. We call these periods investment accelerations because we want investment to grow at least 2 percentage points higher relative to the previous 6 years average. When you look at these episodes, the good news is that around 100 countries since 1950, you have 200 episodes. 200 episodes per country, around 2 episodes of investment accelerations. China is an exception because China has been enjoying an investment acceleration for a very long time, and that is still ongoing. But you look at other countries, on average, only 1/3 of them was able to trigger an investment acceleration over the period from 1960 to 2022. The share of countries that started an investment acceleration peaked in the first decade of this century, in 2000s. But then, since investment is slowing, of course, the share of countries that basically deliver investment acceleration declined significantly, as you see on the right. Now, what happens during investment accelerations? First, of course, investment picks up, as you see on the left, from around 3%, outside of these episodes, around 10% on average growth you see in investment. Output growth increases significantly from around 4 to 6%. And when you think about productivity growth, which is critical, that also increases significantly by actually 4-fold. You see higher pace of structural transformation, the growth of manufacturing and services sector, they both accelerate. And you see the poverty headcount declines significantly at a much faster pace during these episodes relative to other episodes. And then you look at monetary and fiscal indicators, financial indicators, trade and FDI. Surprise, surprise. The economy is heating, but at the same time, inflation declines. Government debt declines. Real interest rate comes down. Economy exports more, much faster, growth of exports, and able to attract a lot of FDI relative to other periods. Now, why this happens? It happens because investment accelerations almost always are accompanied by comprehensive policy reforms. Some reforms are more effective than others. Fiscal consolidation is critical. You need to basically take care of your fiscal house. But financial reform is also important. Trade reform is also important in terms of increasing the likelihood of these episodes. External environment is critical. If you have higher global growth, the likelihood of acceleration is higher. If you have basically better institutions, the ability to spark investment acceleration is much stronger. What is important is to have a comprehensive package of reforms. When you have a comprehensive package of reforms, the impact you see in the aggregate is much larger than the sum of the impact of piecemeal reforms, as you see on the left. Acceleration of investment is critical to turn the tide with respect to the slowdown we see in global potential growth and slowdown we see in many countries' potential growth. In fact, over this decade, it is possible to reverse the slowdown in potential growth by undertaking investment accelerations in a synchronized fashion in many countries. Finally, let me turn to policy priorities very quickly. At the global level, there are well-defined challenges. We have the climate challenge, we have food insecurity, we have debt distress in many developing economies. We need to bolster global cooperation to overcome these challenges. When it comes to trade and investment networks, it is going to be imperative to preserve the rules-based international order and expand trade agreements. And we never forget the challenge of climate change, and we need to find ways to accelerate the decarbonization process. And that will require all hands on deck global effort. Of course, there are challenges at the national levels we need to think about with respect to monetary and financial policy and the fiscal policy. Inflation is coming down in many countries. It's going to be critical for central bankers to basically exhibit a credible stance with respect to monetary policy and communicate their decisions very clearly. Now, with respect to fiscal policy, unfortunately, in many countries, fiscal space is limited. That means on both the expenditure side as well as revenue side, countries need to undertake reforms. Spending efficiency should be increased, and we need to eliminate these regressive subsidies, especially subsidies in the context of the carbon emitting energy sources. Now, beyond the near term, we need to find ways to boost growth and increase the resilience of the global economy. I already talked about how to accelerate investment, but lifting long-term growth will require more integration in the context of trade, eliminating trade barriers, not less integration, not more inward-looking policies. In many countries, we need to strengthen education systems. We need to basically have stronger social protection mechanisms and make sure basically a big chunk of society able to cope with shocks, and we have seen many of them, and become resilient. Inclusion is the key word, and bringing parts of the society, especially the female, increasing the female labor force participation, going to be important in many countries to basically make sure potential growth is not declining further. So let me summarize very quickly. The first question I ask, what are the near-term prospects for the global economy? Global economy has shown remarkable resilience, much better than what people expected, delivered growth. But a slowdown is underway, and we will see the third year of that slowdown in 2024. Monetary policy will remain tight, and trade and investment remain quite subdued. Those are the reasons why we see this weakness in the global economy when it comes to growth. Risks are still on the downside, and the geopolitical tensions, heightened geopolitical tension, is the number one risk. Second question I ask, what should we do to accelerate investment? And there I explain the magical story associated with episodes when you see this sustained investment growth over a period of time. But these types of periods require a Herculean effort on the part of policymakers. The big question is, which countries are going to undertake these types of comprehensive policies to push forward and spark investment accelerations? With respect to policy priorities, I think at the global level, we need to work together. We need to work better. There are big global challenges. We need to find ways to address them. We need to, have consensus on the problems and the solution of the problems. Now, with respect to investment and the limited fiscal space, countries need to find ways to mitigate the trade-offs between that sustainability and large investment needs, reducing gender gaps in the workplace and bolstering inclusion going to be critical to cope with the decline in potential growth. So you can follow me on LinkedIn. You can also visit our webpage, the Prospects Group. In addition to publications Gerry mentioned, we have a number of studies looking at the major problems the global economy facing, including weakening growth, weakening productivity, inflation challenge, and the debt challenge. With that, let me thank you again, Gerry, and the colleagues at the IFF for inviting me, and I look forward to having the exchange. Back to you, Gerry.
And thank you so much. This was a really penetrating, fascinating presentation. You've really raised some very profound issues. I see questions coming in to online. That's great. We'll get to as many of them as we can. But I want to turn first to the General Secretary of the IFF, Junhai Lin. Junhai, if you're there, do you want to get us kicked off with a couple of questions?
Good evening, Gerry, and also good morning to those in China. Ayhan, thank you so much for your really comprehensive and informative presentation. You cover so many critical issues to global growth, and I'm particularly impressed by your deep analysis on investment accelerations and how important they are to sustain global growth. So I have just two questions, if I may. The first question is, in your presentation, you project an improvement in global trade growth in 2024 compared to 2023, which basically didn't grow anything. So could you kindly elaborate a little bit more about the reasons for such an improvement in 2024 as you see? Second question, if time permits, could you kindly explain a little bit more about how you see the impact of the global economic fragmentation on developing countries, and how well are these countries coping with such an impact? Again, thank you so much, and it's just great presentation.
Thank you, Junhai. Ayhan, would you like to take those couple of questions, and then we'll move to the online?
Yeah, thank you, Gerry. And Junhai, thank you for your question. Between Gerry and you, I feel that we are at a board meeting in the IMF.
Thank you.
So for those of you who do not know, Junhai was the secretary of the board, of course. This trade issue is critical, and we actually released a blog on this one last week ahead of the World Trade Organization ministerial. Last year, we had this trade growth very weak, primarily because manufacturing production was weak, and of course, you still had the challenges in the context of supply chains stresses were moderating. The hope for this year is that we will see pickup in basically manufacturing a little bit in hopefully many countries, and those supply chain disruptions will be, totally eliminated. Of course, as soon as I say that, you are asking, how is that going to happen? Because we have problems in Panama Canal, we have problems in Suez Canal, and there's possibility of these problems intensifying. So there are significant risks associated with our trade forecast. If these disruptions we see, especially in Suez Canal, intensify, and we have escalation of tensions around Suez Canal, already we see, the significant diversion of traffic from Suez Canal that has implications for the time you ship things and the cost of shipments. In the context of Panama Canal, the water levels quite low. That affects, of course, the number of ships that can pass through. Your second question, the fragmentation is critical. When countries undertake policies that lead to fragmentation, there are some winners, but in the aggregate, there are many losers. When you look at policies associated with fragmentation, you make the supply chain more complex, not less complex. Supply chain longer, not shorter. So ultimately, for the end consumer, the cost of products obviously increase. So you are, in a sense, introducing distortions into the system. And from the perspective of developing economies, when we think about the role of many of these open economies, the role of trade, the weak trade is basically first order negative for their development, for their ability to deliver growth. Since the fall of Berlin Wall, we have basically observed a significant increase in trade growth. With that, significant progress when it comes to many of development objectives, especially poverty. So the fact that engine of growth is now stuttering because of course, the weakness we see in trade, because of the fragmentation of trade and investment networks, simply troubling. Back to you, Gerry.
Hey, thank you, Ayhan. Thank you, John. Hi. Let's take a few questions online. We see them coming in there. Ayhan, I'm going to try and cluster some of these. Great questions. Some overlap in places, so let me try and just cluster them. There's a few questions on the global economy, and there's one there, Ayhan, that's saying, well, how do you define soft landing? Okay, what do you mean by that? What would that mean for the global economy? Relatedly, still on the global economy, there's a question about, well, the commercial real estate sector, that's been much in the news. What impact do you see, given the outlook for the commercial real estate sector, on the global economy, on global economic growth? Is it going to be a drag? That's kind of the question. And then the third one I'll put in this cluster, Ayhan, and then we'll come back. The third one is this question from Bar Bektimirov. I think it's a very good question. He's essentially asking about how do you strike this balance between high growth, real GDP growth, and high inequality? How do you get a better balance? And what is the trade-off that is being made between going for growth and reducing inequality at the same time, which we all want to do? Your presentation did touch on this, but I think it's worth coming back to. So those would be kind of the three global economy questions, Ayhan, and then we'll come back again.
Thank you, Gerry. These are all good questions. What does soft landing mean? So when we think about the likelihood of soft landing, obviously it's much higher today relative to what we had 6 months ago. Inflation came down. We did not see a recession in an advanced economy. We did not see any financial crisis in a major emerging market. In the past, when you had these types of interest rate increases, the tightening cycles, emerging market economies had troubles. Sometimes many of them had troubles. Gerry knows, John Hai knows. So it did not happen this time. What happened is that global economy has been slowing the third year in a row, but that slowdown has been mostly orderly. So if it continues this way, if we do not see a significant downturn, that's what we call a soft landing. And then, of course, in the meantime, we will see a reduction in interest rates in due time when central bankers are convinced themselves with respect to the sustained decline in inflation. And I think in the baseline I described today, we see a soft landing in the global economy. That's our baseline. The commercial real estate sector, there obviously challenges have two dimensions. One, really the structural challenge, especially after the pandemic, you have significant vacancy with respect to offices. And it's not clear you can overcome that anytime soon. And there are challenges associated with basically a lot of retail moving online as well. So the big issue is whether the problems in the commercial real estate sector triggers problems in the balance sheets of financial institutions. So far, that has not happened. And the regulators have been paying attention to these developments very closely. In our baseline, we do not see a kind of a major problem in the context of commercial real estate sector, basically triggering a balance sheet problem to the extent that it leads to financial stress in advanced economies. Now, the cyclical dimension of the problem is related to high interest rates. As interest rates come down, the challenges in the sector can moderate, but those underlying structural problems are going to be there. So in a nutshell, it will take time to address the problems we see in the commercial real estate. But for the moment, for our baseline, we think this problem is contained. With respect to the challenge associated with high growth and high inequality, I mean, here there is quite a bit of emphasis on income inequality when we discuss these issues. But the main challenge is to address the inequalities that lead to income inequality. And when we think about income inequality, we need to think about whether different segments of society have access to the type of opportunities, middle income or higher income segments have. Do we basically have a kind of a mosaic that leads to equality of opportunity, especially for younger generations? And inequality is, a problem. It will take generational solutions to address and sustain growth. I think in the context of this investment accelerations, we did look at, you can have these periods of very high growth. At the same time, actually, you can reduce inequality along with poverty. But the issue is that the growth per se is not going to be the kind of the key. It is the key, it's necessary, but you need to basically equip that growth with the types of policies that will also improve overall inclusion and the equality of opportunity. What does that mean? You improve access to healthcare, you improve access to education. Basically, you improve the opportunities you present to the segments of the society who are basically in the lower income echelons, and they progress. It is easier said than done, but this is one of the issues we need to be frank. Growth is necessary. We need to expand the pie and then share the pie. But there, it's not just expanding the income. It is basically giving the opportunity to people to have sustained income. And everywhere, always, that goes through education, health, and then primary services. Those can be expanded through higher growth, but then you need to basically make sure you have policies in place that take that growth dividends and distribute to society. Back to you, Gerry.
Thank you very much, Ayhan, for those answers on the global economy. Looking at the questions, there seem to be a number of questions about the two largest economies in the world, the US and China. And a number of questions have come in from Xinhua and Taixing magazine, and a few other places from our colleague Daryl in Singapore. Anyway, again, the questions are quite long, and I'm going to try to just paraphrase them a bit so we give Ayhan enough time to come back to them. Basically, as I read these questions, one is the US, one is China. On the US, the question is basically, how do you see the outlook for the US economy? And related to that, inflation, the timing of Fed interest rates, of course, everyone's interested in that. US employment, US consumption. Basically, I think the questions are around how do you see the prospects for the US economy in 2024? And then similarly, I think on China, it's basically the same set of questions. How do you see the outlook for China's economy in 2024? How do you see China's role in the global economy? And actually, there's one other sort of good question, not good question, but more focused question on China, because clearly they picked up on your excellent point about the magic of investment acceleration. I haven't myself quite heard it described that way before. I found it extremely interesting. Anyway, on China, there's a question also about what can China do to further enhance the attractiveness of investment, particularly foreign investment, but investment. So there's a lot in there, Ayhan. I'm sorry if you can unpack it for us, but basically the questions on the two big economies in the world, how do you see them in 24?
Yeah, thank you, Gerry. Very quickly about the US economy. We are expecting the US economy to slow this year. Last year growth in the US around 2.5%. So this is, a much higher growth than the US's potential growth. And it's quite surprising that the US was able to deliver this type of growth in an environment you have these record high interest rates. Now, there are good reasons for that. The fiscal support was there, excess savings was there, and then, of course, the resilience in the labor markets and the resilience we saw in consumption. This year, I think these things will continue playing a role, but to a smaller extent, so the economy will slow and increasingly feel the lag impact of the tight monetary policy. With respect to the Fed policy action, the inflation is coming down, but there is quite a bit of persistence when it comes to core inflation. Okay, this is the part of inflation you take out the more volatile components like food and energy prices. And as much as we have seen this sustained decline in inflation going forward, we think that it is going to take a little bit of more time to get to the levels to make the US Fed comfortable to have these successive declines in interest rates. We are expecting, the Fed to start cutting interest rates in the second half of this year, in June or beyond. And then depending on data, to calibrate the pace of the interest rate cuts. So I think what we saw even the past, I would say 6 weeks, clearly shows there is a lot to be digested before jumping the gun and thinking that the Fed is going to start cutting interest rates in March. That is not going to happen. There is still inertia when it comes to inflation, and the Fed needs to convince itself that inertia is basically not there anymore to see this sustained decline in inflation going forward. In the context of China, let me make certain points. Growth in China rebounded last year to 5.2%, following the reopening of the economy. This year, the growth is going to slow to 4.5%. Now, this reflects the deceleration we have been observing in consumption. With the reopening, there was a boost, but unwinded, and household spending is held back because of subdued consumer sentiment. So investment, we are expecting to remain somewhat weak this year and next year. But the investment will be supported by infrastructure-related stimulus. It will be, it will continue to be weighed down by weakness in the property sector, which is, we think, recover gradually. So this forecast has in the baseline this nice trajectory of slowdown. And when you think about the Chinese economy, that's exactly what the policymakers would like to do, get the kind of a growth rate, sustainable, high quality growth. And China is on that trajectory. Now, the question about what can the authorities do in the context of investment or in the context of broader challenges. Obviously a predictable regulatory environment that supports fair and competitive markets is critical for boosting investment. Whether that's domestic investment or foreign investment, Gerry, this is not about China. This is, wherever you go. Well-functioning product and factor markets that basically allow resources to move to their most productive uses, critical for China as well as other countries. I think in this context, the policy interventions that can promote a level playing field between the state-owned enterprises and other firms through, ensuring competitive neutrality and removing, certain implicit guarantees. When you think about the firms, reforms can basically facilitate firm restructuring and exit of less efficient firms while promoting the entry of new more innovative firms. And you would like to ease the, most binding regulatory, institutional, and financial bottlenecks to let the kind of the successful firms to flourish, invest, and expand. So the big challenge, everywhere and always is policy credibility. And in the context of, the emerging developing economies, providing specific implementation details in conjunction with these policy announcements, critical. I think that what we also recommend to emerging developing economies, consulting with businesses, other stakeholders, providing the necessary transition periods when certain policy measures implemented in the context of especially regulatory changes, critical. And I talked about investment accelerations. It's not like, China needs an investment acceleration. China's challenge of obviously to move away from investment and export-driven growth to consumption, services-driven growth. And I think the kind of the strengthening the consumer confidence in the short run and undertaking the types of reforms necessary to improve the growth prospects in the long run, going to be critical. China has done remarkably well and has the policy means to overcome the current, challenges. The issue is that, how it's going to address the kind of the slowdown we see in consumption and the subdued consumer sentiment. Policymakers have already implemented certain measures, and we expect them to build on those measures and address the challenges. Back to you, Gerry.
Thank you very much, Ayhan. We are almost out of time, but if I can, Ayhan, squeeze in one last question. The reason I want to squeeze it in, it's coming from the BIS in Hong Kong, the Bank for International Settlements. So I want to take their question. We've had questions tonight from Kazakhstan, from China. Now we've got the BIS weighing in. Actually, it's Dejama at the BIS. He was asking about China. I feel you've answered that. Ayhan, no need to go back into it. But he was also asking about India. So would you have a 2-minute snapshot of prospects for India? And that will close us out for this evening.
Yeah, thank you. And it's great to hear from Deji. India has done something remarkable in terms of putting together this very strong growth momentum. And we think that that growth momentum will continue in the near future. India can deliver growth 6 to 7% actually, and that will be achieved, that can be achieved without overheating the economy. In fact, India's growth potential is consistent with the type of these growth numbers it is delivering. We are expecting, the private investment to pick up, to even accelerate growth. And then, of course, the government creating the type of climate for businesses to flourish, supporting growth further. The central bank has done quite well in terms of addressing financial vulnerabilities, addressing the challenge in the context of inflation. So all in all, Gerry, we are quite optimistic about India's prospects, given the kind of the momentum it has and how Indian policymakers have been approaching the kind of the private sector and providing the necessary climate in the private sector to flourish. Back to you.
Thank you so much, Ayhan, for squeezing that in. That is going to bring us to the end of this, I think, fantastic presentation from Ayhan. Really a 360-degree panoramic view of the global economy in 2024. And again, I just want to express deep appreciation to Ayhan for taking the time tonight and for taking all these questions as well as making the presentation. I want to thank Junhai, Joanna, Steele, and others at IFF also for helping us put this show on the road. And we'll be doing this again quite soon. Ayhan, my takeaway from you tonight is something I had not heard before, and that is the magic of investment acceleration. Thanks, everybody.
Thank you.
We'll see you soon.
Thank you, Gerry. Thank
Bye-bye.
you, everyone. Hope to see you again in
Ayhan.
person
Thank you.
soon.
Thank you so much. Thank you. Bye-bye.
Bye.
那韩静姐只推流。